Hello everyone, this is Professor Wei here. In this video, I want to continue our discussion on the topic of equity valuation model, which is a very important topic in this course. This equity security, as I mentioned many times, is the primary financing instrument in the capital market. Okay. Uh, let me first share my screen. So I understand the first test will be coming up, but as I stated in on the Canvas announcement, I think there are only very limited amount of questions related to the lecture today. It was my intention because I want to give you enough time to digest the material, and I will, ask you to work on more questions on the next test. Okay. Uh, now, last time we covered the very first type of equity valuation models, which is the dividend discounting based valuation approach. So that is essentially derived from the DCF model, discount cash flow model. So we argue, or we assume, firms constantly pay dividends, and the value of the stock is nothing more than the discounted value or discounted payoff of future expected dividend with an appropriate discount rate. Okay. I think last time I shared with you a graph which I really like, and that is this framework. Okay. So the value of the equity is the value of a series of future expected dividend payout. Okay. The dividends are driven by firms' dividend payout policies. So you can grab those accounting numbers from the financial statements to see how much the firms are going to pay out of their earnings, the net income. Okay? The dividend is nothing more than the product of net income and the payout ratio. That's how you derive the dividend. Assuming firms are constantly paying certain dividends, if it's in a healthy financial condition, it is fair to assume the dividend is growing over time. So there might be unexpected growth. Therefore, we need to find out the potential growth rate. In the video later on, I'm going to show you how to derive the growth rate, and that is driven by the clawback ratio or retention ratio. So the cash flow is pretty clear. You have dividend 1, dividend 2, and dividend 3 until forever. We also mentioned last time a very important notion, and that is the terminal value. So whenever we sort the firm into multiple stages, if you discount back all the future cash flow in the subsequent stage to the ending point of the last stage, and we call that discounted value to be the terminal value. It's a forward-looking measure. It captures at that time point what's going to be the firm value. Sorry, the share value. Okay. Now, to establish the discounting process, we need a discount rate. That rate is sourced from the cost of equity. All right. So in the second half of the semester, I will talk about the capital asset pricing model with the central idea that you can decompose the firm's return into a risk-free component which is captured by maybe the short-term treasury yield, and a risky component, and that is the product of beta, which is the market sensitivity, and the market risk premium. Okay, we'll talk about that later. But at a minimum, we have a way to come up with the cost of equity, and that is the number we are using to discount back all the future expected cash flows. So that's the scenario we assume firms are constantly paying dividend. So in other words, the share of the stock, the share of the equity is the future expected payout of the dividend. When you sum them up, that gives you the share price. Very simple. So you can use this Finance 101 formula to capture the share value. However, there is a limitation because the cash flow pattern may be varying. There are different scenarios in the real world. Okay, so for example, we have perpetuity. A live example is the preferred stock, right? So you just cannot manually discount back every single payout. You have to use certain mathematical, shortcut or formula to establish the value. We call it perpetuity. Okay. A second cash flow pattern we visit is constant growing perpetuity. It means that it is a perpetuity, but the level of the cash flow is growing over time. Okay, that's what we discussed last time. We have a beautiful name. We call it Gordon dividend growth model. That's the the term on your textbook. Okay, the idea is that we assume firms are constantly paying a growing dividend to the shareholders. So you can see the level of the cash flows is different. There's a slope. The slope of the cash flow is the growth rate. We'll discuss how we derive the growth rate. Okay. The third cash flow pattern we talk about is a two-stage model where you have two stages. The first stage is a super abnormal growth stage. A typical example is small startup firm where it is growing at a very fast speed because it plow back everything they generated internally for future growth. And after a couple of years, because of the market competition, well, the growth rate is lower, so the slope of the cash flow is less than the first stage. Okay? To do that, you have to discount back cash flows stage by stage. Okay? Not sure if you still remember the in-class example we have. That is, we discount back all the second stage cash flows to the ending point of the first stage. We call that number to be the terminal value. The second step is to discount back that terminal value along with the first stage cash flows to the present, sum them up. That gives you the share price. Again, the reason why we have to do it stage by stage is the fact that we simply cannot do that manually because this is a perpetuity, right? You have this little dot, dot, dot. That means that it's the infinity. You cannot do that by hand, right? So don't be overwhelmed by those formulas. It's just a representation that help you to understand the cash flow pattern. Okay, so there is a nice table that sums up the cash flow patterns we are exposed to. So we have perpetuity annuity, constant cash flow level and a growing cash flow level, so that it is sorted into a 2x2 dimension space. You have constant perpetuity, constant annuity, growing perpetuity, and growing annuity. You don't need to memorize everything. Yeah, this is the example we worked on last time. Let's take a look of another example. So suppose the company has an innovation product, okay? The firm projects a growth of 20% over the next 4 years. By then, other firms will have sort of a copycat technology, competition, will drive down profit margins, and the sustainable growth rate will fall to 5% from 20%. The dividend just paid is given, a discount rate is given. What's going to be the share price? Okay. Now, this is a typical two-stage growth model. All you need to do is to draw a timeline in the first place. Okay. For the first stage, it lasts for 4 years. So 1, 2, 3, 4. For the second stage, starting from year 5, it is growing over time constantly. Okay. Now, on Canvas, I shared with you guys an Excel spreadsheet. Let me share with you the spreadsheet real quick. So the first stage growth rate is given 20%. Second stage growth rate 5%. Now this is the timeline. The dividend just paid is $1. For the at the end of year 1 is 1 times the first stage growth rate. Okay, you do that over time for the first stage. Okay, so 1 times 20%, 1.2 times 20%, or 1 times 1 plus 20%, 144 times 1 plus 20%, all the way to the ending point of the first stage. And the ending point of the first stage is right here. All right. So this is the starting point of the second stage. Okay. To do that, to get that to 18, you need to use the very last cash flow at the ending point of the first stage times 1 plus the second stage growth rate. Okay. Now, with the initial cash flow on the second stage generated, you can calculate the terminal value by using the Gordon dividend growth model. So 218 divided by the difference of required rate of return and the second stage growth rate, that gives you the terminal value. Everything else being the same with what we did last time. So you just need to sort out the present value of every single cash flow on the first stage along with the terminal value that gives you the share price. It's exactly the same with the process of our example last week. Okay? Yeah. Feel free to revisit the Excel example. So let me repeat it again. Well, first, you need to generate the dividend payout on the first stage and the second stage. To get the second stage dividend, you need to be careful. I saw lots of students made a mistake. You have to use the second stage growth rate and apply that to the very last cash flow on the first stage so that you have the second stage dividend. With that given, you can derive the terminal value, which is the ratio of cash flow, and that is the first dividend payout on the second stage, and the difference between the required rate of return and the growth rate. That gives you the terminal value. So all you need to do in the next step is to discount back all the cash flows. That gives you the share price. Okay? So it's 34.74. Okay? Again, I want to emphasize that I'm just using Excel as a platform to show you the concept. It's not about how we work on everything on Excel. It's all about whether you understand the rationale behind the model. All right. Now let's go back to my slides. Hmm. So now, one thing that I want to recap is the retention rate. It is a very important idea because it helps us to get the idea of the potential growth of the company. All right. So it's largely driven by the firm's payout policy. The plowback ratio is defined as the addition to retained earnings divided by the earnings that is measured by the net income. Okay? It is also equivalent to 1 minus the payout ratio. How to get the payout ratio? Well, that's the dividend divided by the net income. How much you pay to the investor is the dividend. The rest of the amount is preserved for future growth. Very simple. Okay, so we use the letter B to denote or represent the retention ratio or retention rate or clawback ratio. This terminology refers to the same idea, how much you preserved for future growth. Okay, so the growth rate is the product of the profitability measured by return on equity times the plowback ratio. In this course, you can ignore. You will not be. You are not responsible for the second type of a representation. You only need to understand this one over here, and that is the growth rate is the product of the profitability. Profitability measured by ROE, return on equity, and the plowback ratio. All of the profitable cash flows, profitability, how much you're going to save for future growth, right? So that's the idea of a growth rate. There are some number crunching examples on my slides. Feel free to take a look. Okay. The second approach of valuation is even easier. Okay. So that is that can be applied to the context where firms rarely pay dividend or never pay dividend. Okay, so our prior model assumes firms going to be paying dividend over time. Now, if we do not have the input, we can use the financial multiples. Okay, to do that, we need to get the idea of PE ratio, price earning ratio, which is the ratio of price per share and over the EPS. The EPS is net income divided by the number of shares outstanding. Okay, right? Now, the beauty of this financial multiple approach is that you can calculate the share price without touching the dividend information. So the idea is that we can find out the EPS easily from the accounting statements, right? All we need to do is to sort out a benchmark PE ratio from the its industry peers. For example, when you are talking about let's say Microsoft, all right, you may compare this mega cap company to some other high tech companies like, I don't know, Apple, Google, Amazon, right? So you can find out some industry or industry peers or comparables and calculate the average of industry peers of their PE ratio and use that benchmark as a number to establish the share price. You can also create a lead-lag relationship using the growth rate to calculate the EPS next period so that you can generate a target price. Simple and powerful. That's the beauty of this approach. Now, a major disadvantage of this approach is the fact that the selection of benchmarks could be biased. All right, it's subjective. Whenever you pick up different companies, you always have different numbers. And the other thing is that there might be inconsistency between this approach and the cash flow based approach. Okay. Now, the third valuation approach is what we call the alternative DCF model. Okay, I will talk about two alternative methods. The first one is what we call the earnings model. The second one is free cash flow approach. Okay, to introduce the earnings model idea, we want to talk about the something called PVGO, present value of growth opportunity. Okay, this G stands for growth opportunity. Okay, let me show you one thing over here. On this slide, I argue that you can disentangle firm's value into two parts. The first part is what we already established in the firm. We call that asset in place, like PP&E, fixed assets, all right, what you already have. The second component is growth opportunity. Okay. This idea is extremely important. So whenever we evaluate a company or an asset, you can always decompose them into asset in place and a growth opportunity or growth option. As I mentioned one time in class, you can think of a company to be a collection of profitable investment ideas. And those investment ideas are the drivers of future growth. All right. So you can think of the idea of constant growing perpetuity, right? It is the upward sloping trend of the cash flow level. And you can decompose it into two parts. One is the perpetuity down the bottom, and upside is captured by the PVGO, right? What is it? What is the first term? It is the perpetuity. The second term is the growth opportunity. It's a call option. Okay, let me decompose the idea. Suppose a firm pays out 100% of its earnings as dividends. In this case, the dividend is equal to its earnings per share. And the growth rate must be 0%, right? Because they pay out everything. You don't have anything preserved. Now, what's going to be the price of the common stock? It's a perpetuity, right? That's how we derive the first term. Oh, by the way, the derivation of this model is not required. It's not required, so don't be overwhelmed. I'm just trying to give you the idea. So this is the idea of asset in place. Now, let's talk about the second term, the present value of growth opportunity. Your textbook has some discussion on the PVGO, but I think it's not very clear. Now, PVGO is subject to this, derivation, okay? So what is growth rate? It's the product of clawback ratio and the ROE out of the profitability, how much you're going to preserve, right? So as I mentioned, the driver of firms' upside growth or growth opportunity, growth option, is nothing more than a collection of future investment and ideas. Okay? And those ideas can be visualized as a series of NPV projects. So the value of the NPV project is nothing more than the value of the PVGO. When you sum them up, that gives you the present value of growth opportunity. Okay, so all you need to do is to discount back all the future NPVs. That gives you the PVGO, right? So every single NPV captures the value of every single investment ideas at each time. Okay, so here you may ask me, hey, professor, why you need to use the constant growing perpetuity model to discount back all the investment ideas, right? So this R minus G is something we are very familiar with. It's the Gordon dividend growth model. Okay, so that is the assumption. Okay, let me be straightforward. It's the assumption. We assume in a healthy financial environment, those ideas are, the value of those ideas are more and more profitable, right? So you cannot just, so let me, for example, I know lots of you are big fans on Apple using iPhones. So let's say if Apple's, the company always send out a signal that every single cycle they are going to update the color of the cell phone, the iPhone, right? So this year, this quarter, sorry, this season, we are going to release another cell phone. And this idea is nothing more than we're going to change the color. We're going to introduce another pink color. Okay, that's idea one. Next cycle, we are going to introduce another iPhone and the color will be blue, something like that. So there's nothing fancy about these ideas. It's almost identical. It's not value enhancing. So we assume next cycle, you have to get another profitable ideas, right? So the NPV is supposed to be growing over time regarding each investment ideas. That's why we assume constant growing perpetuity model or Gordon dividend growth model might be a reasonable representation of this context. Okay, so that's why we discount back all the NPVs with R minus G. So what is NPV? It's the discounted future expected payoff minus the initial outlay, and the initial outlay is the return earnings. All right, return earnings times the profitability divided by the growth rate is the discounted payoff. It's a form of perpetuity that gives you the NPV. If you don't fully understand that, that's totally fine. At least we have a way to generate the NPV so that we can calculate the NPV. A PVGO. All right. After some sort of a substitution, that gives you the price of the common stock, where the first term captures the asset in place, the second term captures the growth option, the present value of growth opportunity. Okay. So on my lecture notes, I have another example regarding the PVGO. I have the Excel demonstration posted on Canvas. You can take a look. It's nothing more than a number crunching practice. Let's take a look real quick. So you have those accounting numbers: EPS, payout ratio, ROE, growth rate. Well, actually, growth rate is derived from those accounting numbers. You can use the model we introduced to establish the value of the stock. It's nothing more than the asset in place times plus the growth option. Okay, you can see it's consistent with the constant growth dividend discount model. Okay, I'll leave that for you. Now, let's go back to the lecture notes. I want to discuss with you the last approach, and that is another alternative model where we do not assume it's going to pay dividends. Okay? So the idea is that instead of estimating the firm payout with dividend, we are going to estimate the firm value with free cash flows. So we no longer directly look at the share price. We look at the firm value. Okay? So your textbook, excuse me, your textbook gives you this formula that free cash flow equals after-tax EBIT plus adjusted by the depreciation minus capital expenditure minus the change in net working capital. Okay, this is just some sort of accounting adjustments to gauge the free cash flow. You will. I won't test you on this formula, but it's a pretty standard practice to calculate the firm cash flow, free cash flow. So suppose this is the input. What are we going to do? We are going to calculate the firm value. Thank you. And that is the discounting process of firm free cash flow with the appropriate discount rate. And that discount rate is something very important. You derive that from your corporate finance class, and that is what we call the weighted average of cost of capital. That's it. The non-operating asset refers to something similar to the notion of a firm's cash or money market instruments. Okay, so these are pretty liquid. Okay, so that's the firm value, right? Very simple. The firm free cash flow. When you discount it back, that gives you the firm value. Now, what's the point of doing this? Remember, our objective is to establish the value without looking at the dividends, and that gives us a channel. So we established the firm value in the first place. Now we just need to back out the value of common equity, and that is the difference between the firm value and the firm liability, and of course, the preferred stock. Okay, that's it, right? So sort out firm free cash flow, find out the VAC, find out the weighted average cost of capital and the growth rate, establish the firm value, and then pick the difference between the firm value and the firm liability. That gives you the equity value. And you discount it, you scale the common equity value by the number of shares that give you the stock value on the per share basis, which is the stock price. All right. So now let's take a look of the very last example of on my slides. You have all sorts of accounting information and how to calculate the free cash flow, how to calculate the stock price, and that is captured by, let me reshare my screen on the Excel, this thing over here. Okay, so you have the historical accounting information. Following standard accounting adjustments, you get the free cash flow, and you can forecast the hypothetical free cash flow next period. Okay, and use that free cash flow to generate the firm value. Okay. Once you get the firm value, you can easily derive the value of the common equity. It's the difference between the value of the firm and the liability. If firm has some cash holding, you need to add the cash back. Scale the firm equity value by the number of shares. That gives you the per share basis, the per share based stock price. That's it. Again, you don't need to be responsible for the Excel calculation. The whole idea is to help you to understand the approach we're talking about. In your 359 quant finance class or financial modeling class, we'll get this approach fully covered in terms of how we implement everything on Python or Excel. Okay. Okay. So on the bottom of my lecture notes, there are a couple, easy calculation questions that help you to get the idea of the topics we covered. So, but more importantly, I want you to revisit my lecture notes and the textbook chapters. These are very important. Make sure you get yourself fully covered. Okay, so that's all what I have for this topic. Uh, on the next video, I want to talk about the financial statement analysis and common size financial statements, which is a complement to this video. Again, just briefly recap, what we did within this set of lecture notes is that we covered three approaches. The first one is, hold on. The first one is the discount cash flow approach. The second one is using financial multiples. The third one is the alternative discount cash flow approach using PVGO and the firm's free cash flows. Okay, so for the earnings model, we decompose firm value into present value of growth opportunity and the asset in place. And for the firm free cash flow approach, we use the firm cash flow, free cash flow to calculate the firm value, and the use the firm value to back out the equity value, okay, without looking at the dividends. So that's what we have for this topic. In the next video, I will talk about the financial statements, a general framework. All right, I'll see you in the next video.